Hey everyone, and welcome to the Bricks, Bucks, and Bytes podcast, your weekly dive into funding, market, and investor news in architecture, engineering, construction, and supply chain. Before we get started though, if you're a startup founder or operator responsible for innovation in your company, or you want a deeper, more insightful look into technology in AEC, you won't want to miss our newsletter. From deep dives into particular technologies such as AI, robotics, design, software, and so on. Hot takes from investors betting big in AEC technology and advice on building tech companies, including the stories and takeaways of the most successful AEC technology founders. Head over to www.bricks-bytes.com and sign up today to get this exclusive material straight to your inbox. And now for the episode. Good morning, everyone.
Morning.
You nearly let me down less than 5 seconds into the podcast. Hey, we're joined by Shub today. Shub, thanks for coming. It means that we are maybe discussing something around the Indian market.
Yes. Been a while, as you're discussing, only 5 months, but feels like I've been away from this podcast for a long time. Glad to be back.
I think it's important to note that today we took a leaf out of the Practical Nerds preparation book, and we prepared for about 8 minutes before we hit record on this. So I'm excited to see what we have.
I think at least 7 of those was random chit chat unrelated to what we're actually going to discuss.
Yeah, I think they always claim that it takes them less than 2 minutes, so
okay.
It took us longer.
Okay. So today we're going to discuss the current state of the Indian market. We can talk about IPO market generally as well in India and more globally. And then we have some interesting takes from Martin's adventures yesterday, exploring the communist state of the UK. We will then end with some investors' hot takes. By the way, I don't mean that literally. The communist part. Martin, do you want to kick us off with maybe a segue to Shub and India?
Yeah, so last week with Patrick, actually, we started discussing change in capital markets and IPOs in the Western market and specifically more in the US. And Patrick mentioned that there is interesting stuff happening in India, 2 IPOs coming up. One of them is Swiggy. It's a quick e-commerce. Well, it's not startup anymore, I guess. And another one is BlackBuck, which went public actually today. So I think it would be interesting to see more from macro point of view. What does it mean? And is it a common thing that you guys have over there, 2 IPOs in 1 month? And yeah, what's your take on this?
All right. Maybe I'll take some liberties here. Instead of directly responding to what you just asked, Martin, maybe set us up with some high-level macro information, which, when I came across this about a month or 2 ago, it took me by surprise, pleasantly. So this is about some information on company growth rates in the 5 largest economies in the world, right? So in decreasing order of the size of economies, that's the US, followed by China, followed by I think Germany now, if I'm not mistaken, followed by Japan and India. And what that study tracked is looking at all the publicly listed stocks in these 5 economies and tracking the revenue growth rates over the last 20 years. And the study attempted to find how many of these publicly listed companies have grown their revenue at a greater than 20% annualized rate over the last 20 years. So that's a 20% CAGR over the last 20 years.
That's a lot.
On the universe of publicly listed companies in the 5 largest economies of the world. So, starting from the bottom, unfortunately, Patrick, Germany comes at the bottom. There are literally 0 German companies who have grown revenue 20% or higher over the last 20 years.
And that IPO'd in the last 20 years?
No, they've stayed publicly listed. They've either publicly listed in this time or were publicly listed before that. So a publicly listed company which has had a revenue growth rate of 20% annualized over the last 20 years.
Yeah.
Right? So unfortunately,
does that mean, 20% growth each year?
Yes.
Yes.
Okay, fine. Yeah.
Right? which obviously it's a pretty stiff target to maintain for 20 years, right?
At scale.
Exactly. So unfortunately, no German company fits that filter. So there you go, I guess. The next is Japan. Two Japanese companies that are publicly listed fit this description. Then we move on to China, where 5 such companies exist, which over the last 20 years have grown their revenues at more than 20% annualized rate. And then we have the US coming in second to last, there are 35 such companies in the US, which have grown revenue at more than 20% over the last 20 years. Now, I guess no prizes for guessing that India is number one, but anyone want to guess how many such companies exist in India, which are publicly listed and have grown revenues by over 20% every year for the last
174.
Okay.
Hey listeners, I want to take a quick break to remind you about the Bricks and Bytes newsletter. If you're interested in learning about the technology shaping the future of construction, you won't want to miss the valuable insights we share each week. To get this exclusive content delivered straight to your inbox, head over to www.bricks-bytes.com and sign up today. Link is in the show notes. Back to the show.
Owen, you want to take a shot?
I was just going to go 70 as we're double the US.
Okay. Patrick?
250.
All right. So actually, Martin's the closest. The number is 156.
Oh, I didn't do good.
Right?
His wife is from India, though, so.
Oh,
Yes.
that means a lot.
Yes. So that's what you need to do to get information on companies in India, I guess. But
By the way, that can be a reflection of economic growth, underlying economic growth, and it certainly will be. But it can also be a reflection of how early companies IPO. That will influence the success and growth rate post listing much more than the underlying economic growth should.
You know what I should have done, but let me do it on the spot now.
So as you're doing it, I have a tricky question. This compounded growth of 20%, is it after you strip down the inflation or before?
No, this is the nominal or the gross growth, not real growth.
Okay.
Right? So I just did a quick check. So 20% CAGR over 20 years translates to 38 times. So we're talking about companies that have grown at least 30 times. There may be companies that have grown hundreds of times in the sample, but at least 38 times over the last 20 years. And the reason I brought this up is I think this gives you a view. So there's been, I think, over the last year, a lot of discussion on, hey, how vibrant is India's economy? Is now finally going to be the time that, India sort of ascends to its place as an important economy, growing, etc. And I thought it's an interesting way of looking at the fundamentals, as we at Fundamental like to do. Not just judge on the basis of funding rounds and the stock market performance, but look at what the underlying assets are telling us. And I was quite blown away. All the other economies, you're talking about either nothing or single digits, or in the case of US, just 35 companies. Whereas in India, we are working right now with a sample of 156 companies who've been doing this over the last 20 years. So at the outset, it seems like there's a lot to be excited about.
Yeah. And that means flourishing economy, and it means liquidity to IPO, also relatively early in a company lifetime, or at a relatively still decent valuation where you can still grow a lot. Whereas in the very mature industrial markets, you showed Germany and Japan, two economies that would fit that description. Tendentially, the IPO markets reward companies that are very mature, have a lot of substance to them, etc. And the IPO markets are not itself as liquid to very, early kinds of companies, let's say 8 years old. You can always try it, but it's not what gets rewarded on average, which in India, Shub, maybe that is different.
Yeah. I mean, just to be clear, the data doesn't necessarily imply that, these companies have already been listed 20 years ago. They might have been listed 10 years ago, but they have shown the revenue growth rate over the last 20 years. But you are right. There is also seemingly a very clear track record that a lot of upside is possible after listing in India. And the market believes that the IPO is just the starting point and not the
because there's just a scale effect, right? So if you look at Adani Group, Shub, is Adani Group growing 20% year over year, or TCS or Infosys?
No, I haven't checked the numbers. I think Adani Group, there was a period of time when it was growing 20%. I don't know. I don't think that's true anymore.
Exactly.
Although I think Adani is in the news for all the wrong reasons as we are recording this episode. So maybe not the best example to bring.
It's an industrial conglomerate. That's why I picked them, right? And so once you have reached a certain scale, it just becomes, statistically exponentially harder to maintain 20%.
Yeah. That's right.
Is there, what percentage of those, obviously you might not know exactly, but are in the area of what you guys do within fundamental?
Actually, it may be larger than we think. I must admit, I haven't done the analysis. I suspect a large number of them would fit the description of industrials companies, manufacturing, steel related, building products related. You've done both an in-house analysis as well as a Practical Nerds podcast. It is actually mind-blowing how a lot of building materials companies in India are valued and how they've grown, very consistently over a multi-decade period. Actually, a surprisingly large number of them, I think, fit the description of companies that would belong to our sectors. And keep in mind, many of the largest conglomerates in India, firms like Tata, actually even Reliance and a few others, they have substantial exposure to the construction industry, either as GCs or having their own building materials companies or running infrastructure, that sort of thing.
So this journey towards IPO, how is it founded usually? Is it founded by the revenue of these startups or by these general VCs or perhaps more specialized like you guys?
Sorry, just to clarify your question, Martin, is your question who sort of funds or anchors the IPO, or who just wanted to understand the question?
Stages of these startups. Obviously, by the time they go to IPO, I guess they are mature companies, but the early journeys of startups.
Yeah, look, I think things are different now, and we'll get into obviously where we started with Swiggy and BlackBuck right after I answer this question. Most of the companies listed in India today, which is very different from, for example, what you'd see in the US or China, where a significant proportion of the listed companies universe is made of what I guess we could call new generation companies, tech companies, etc. I think in India, that cohort of next generation companies is being created as we speak, which is of course why we're seeing quite a few IPOs coming up. Today, most of the existing universe of listed companies in India, it's traditional companies, industrials, financial services, consumer goods, FMCG companies, that sort of thing, which I guess is reflective of maybe an economy somewhere between a post-industrialization phase and a pre-digitalization phase. That's kind of what's reflective of the state of the economy.
It's also a reflection, though, of the Indian economy creating a liquid capital market system with domestic money. A lot of the capital that goes into Indian IPOs, though, is non-domestic money, right?
Correct. So the interesting thing, historically, if you leave aside the last 2 or 3 years, a very large share, consistently over 50%, sometimes more than 70 or 80% of the share of the amount of money circulating or being invested in the listed stocks has usually been foreign investors or institutional investors based abroad. That has changed quite a bit over the last 2 years or so. So today, consistently, what we are seeing, it's actually an anomaly. And in India's history, as far as I'm aware, there's not been a sustained bull rally that fits this description, where you've had a sustained bull rally without as much foreign institutional investor participation. So most of the participation is actually coming from retail investors investing in mutual funds, stocks. I think, Martin, you had mentioned in one of our discussions from a few months ago that when you were on one of your trips to India,
on the roads,
there was talking about mutual funds, and that is very true. Yeah. It's become more and more mainstream now, for sure.
Yes.
Sure, but are there any, as a result, because you mentioned this last time we sat down with you about this post-industrialization era, are there any construction tech trends that are emerging as a result of this? So companies that are tackling the fact that the company is going through that switch. For example, we saw companies like building material, marketplaces, and so forth. So are there any things that Are there any trends, and are there any kind of maybe future trends as well that you perhaps see emerging
In
apart
India
from crypto? Yeah.
apart from crypto? Okay.
Yes.
Look, I would say there are a lot of, I think, in my opinion, it's still more, what we call outcome as a service in fundamental. Look, of course, the demand for solutions and creation of startups exists in all kinds of areas, as you would imagine in a significant venture market like India. Tons of software companies, AI, all of the like. If your question also was which firms are seeing significant uptick in demand, I think it still mostly fits the outcome as a service model, either through marketplaces or to deliver supply chain solutions. In the last year, at Fundamental, we have seen, interestingly, a few applications of AI being applied to traditional industries like cement and manufacturing, which also are showing very promising signs of scale and profitability. I can't say there's lots of examples of that, but there are a few, which I think even as recently as just 3-4 years ago would be extremely hard to find, maybe even impossible to find. I think things are changing. I think what we are going through is a bit of a phase where, with a lot of mainstream adoption of large-scale B2B marketplaces, the traditional industry incumbents have gotten used to a better standard of what they are expected to deliver, what they're measured against, and what their customers expect. And I think now that has started to create a bit more pull-in for the next level of solutions, where they can maybe pull in technology in other forms as well, outside of just supply chain operations. Will it happen immediately? I'm not so sure. I remain bullish if you take a 5-year horizon, let's say. I don't see it imminently taking up scale, I must admit.
Patrick, have you got any thoughts on B2B marketplaces in the Western part of the world?
I think a lot of investors in between maybe 2015 to 2021 got enamored by B2B marketplaces. But it was still a time when the eventual liquidity that you can generate from exiting a B2B marketplace was yet to be proven for many of them. The marketplace game had previously been proven only by B2C marketplaces for the most part. Now that, at least the way we looked at it, that BlackBuck in India actually made what I think was a great IPO. I think the IPO valuation was like 570 million US.
Yes.
So that is a substantial outcome, especially at a time when, you have to just contextualize this, freight rates have dropped for the last 2 years in most of the logistics markets. And for a freight forwarding B2B marketplace like BlackBuck, the last 2 years were difficult. You had to restructure, you had to very carefully manage your cash, be very financially disciplined, adjust and trim your overhead, make sure that the gross margins increase. You had to overcompensate a drop in shipping rates by, in some cases, 60-70%. Is that right?
That's right.
So you had basically to 3x the amount of hauls or tonnage that you were shipping around as a freight forwarder in order to compensate for the drop. And so for BlackBuck to do all of that and be one of the first really serious B2B marketplaces to IPO, that's a great signal to every B2B marketplace investor anywhere on the globe, including the Western markets, that invested between, let's say, 2015 and 2021 in such models. I think in the West, we're still due proof that the Western markets do support these as well. Shub and I were actually talking about the irony on Practical Nerds last week that BlackBuck was once described as the convoy of India. And for the uninitiated, the irony is convoy is dead. BlackBuck IPO'd. So we should rather call convoy the BlackBuck of the US, right? Which did not work out. So that tells you a little bit how the Western markets had a little bit more trouble sustaining these. For us, India is, for the B2B marketplace part, actually the birthplace of high-performing, well-operated, great market fit type B2B marketplaces. So we have every right to look eastwards into that direction to look for how it's done. Okay. To be clear, in the West, there are good B2B marketplaces too. And Equipment Share in the US is supposedly one of them. A company that, at least from I have angel friends who are invested there who are exceptionally proud to be in that company. And so there are good examples that hopefully in the next, maybe year, maybe two, we can also see IPO, because the IPO window is opening in the West.
Okay. And as we got both of you here, is it okay to ask what's the percentage you guys invested in East versus West?
So look, I mean, do you want me to give you like a very diplomatic by the book answer, or do you want me to
Only the truth.
only the truth? I would say, look, I think, especially from Fund 1, we invested a lot eastwards, and specifically in India. If I had to make a guess, maybe like 30%-ish, which is very large exposure, as you can imagine, into a single country. But
Pretty much exactly right.
yeah, I would say also, I mean, if you take a look at the portfolio, also for the right reasons, I think there's quite a few very exciting companies. We may be expecting 2 IPOs from that portfolio and Fund 1 within the next year, possibly a third if we extend 2 years into the future. So at least as of now, looking into the future, it seems like it was a good decision to make in terms of capital allocation. And yeah,
Would you share these companies or not right now?
Oh, sure. I think one of them we've discussed a fair bit, including on the Triple B podcast. It's Inframarket. By the way, is that what you prefer being called? Do you prefer being called BBB or Triple B?
We say BBB.
Okay, so I'll go with that as well.
Triple B is quite good, actually. It's like Triple H, the WWE star.
Exactly.
Yeah.
Exactly. I was going for the Triple H vibe.
And also, it kind of reminds me of a rating. I'm
sure it does, Martin. I'm sure it does.
What do we need to do to get to Triple A then?
Yes.
Change the host.
Yes, one is Inframarket, which, fingers crossed, they're in the works now for an IPO next year. The other is a much smaller company, or at least a much smaller listing, a firm called Infraprime Logistics, also operating in the logistics for construction materials space in India.
Very good. So the 5% looks like it's was a good choice.
At this point, it feels that way.
Do we want to speak about the Western IPO market maybe a little bit? Patrick, you mentioned that it's opening up, and I've seen lots of talk on X has or of this.
Or if it's on X, it's true. You know that.
Exactly.
Yeah.
So, yeah.
Especially if it's political opinions by Western VCs having an X account, then you can take it to your bank.
We will get to those a bit later, actually.
ServiceTitan is one of the examples that are maybe first rushing into the IPO window. The US had 2 software IPO, two large-scale software IPOs this year already. That was Rubrik and OneStream. And ServiceTitan is a company that I wouldn't classify it as Construtech. I think that would perhaps be a stretch too far, but it's very, very adjacent because it is software for tradespeople. And it is a company that has announced its intention to file for IPO in the coming days. It has recently released its S1, the brochure basically, which gives all the information for potential subscribers to understand the company. And it might be signaling exactly what we are hearing behind the scenes from investment banks we talk to, from, angels, influential people in high quality IPO ready companies, is that the window in the West is opening too. Klarna has announced its intention to file for IPO in the US as well. So we actually think there will be a flurry of IPOs in the West in the next 6 to 12 months here, with ServiceTitan being one that is actually adjacent to what we're doing. And they, the numbers, just not to bore you, but actually it's a very high quality company when you look at the numbers, but it's not even like median of the market in terms of quality. If you look at most of the financial metrics of ServiceTitan, I would be thrilled to be an investor. So I would feel very, very good about the IPO, but it's not even like top decile, top quartile, or even top 50% in some of the metrics. So to give you an idea, the ARR per FTE is about 270,000. That's roughly where Procore, I think, intends to be. And that's like bottom 50% of most of the software companies. The year-over-year growth on ARR is in and around 20 to 25%, which is okay, but at a scale of like 700 million ARR, you see software companies that are publicly listed that actually achieve more like 28, 30% still at a higher scale. And so most of the analysts that look at ServiceTitan seem to think they can be at an ARR multiple in and around to 10 to 12, which is actually more than the publicly listed median for such companies would be. That would be like 7x currently for software companies at that scale. So that would be a really good IPO if ServiceTitan can achieve the 10 to 12x ARR with numbers that signal good company, high quality, but not the highest quality yet.
So question to both of you. So seems like both in the West and in the East, if I can put it that way, these IPO markets are and will be pretty good next year. How these good IPO activities influence your decision making, if at all, or perhaps money raising in general within the VC world?
I mean, look, the thing is, so the reason why I started with the commentary on the revenue growth rates in the different markets is for me to also assess what the underlying fundamentals are and if there's a basis for why we should see a sustained IPO rally or demand for more IPOs. Now, with that said, as I think one thing you realize, obviously, if you're paying attention and not too occupied on X all the time, is we are a very cyclical industry, and it helps to pay attention and to realize that it's an undeniable truth of the industry. So I feel we are at the start of a very nice point, a very nice part of the cycle where there'll be more liquidity, more exit events, more IPOs. But just as surely, I'm preparing for the fact that at some point in time in the future, maybe 2 years from now, 3 years from now, maybe sooner, the cycle will turn unfavorably. And what you don't want to do is to base your thesis in terms of investing or deployment on the good times continuing into perpetuity. It should still hold true for when the cycle turns. So yes, obviously, as would any investor, we'd like to take advantage of the situation, but the idea is not to kind of, be so deep in the excitement that you lose what you're doing when the tide recedes.
Okay. Is there any construction tech IPO that you guys would like to see?
You mean other than the ones that are happening in our portfolio?
That's a good answer. Yes, but other
So I think
something obvious that should happen, but it's not happening for some reason.
Patrick, do you want to reply? Because I could otherwise jump in on Martin's question.
So in the Western markets, obvious ones, Martin, in my opinion, with no, let's say, me being involved with the company, I only have angel friends there. Equipment Share is a company that would be, from the quality perspective, a candidate that if it were in my portfolio, I would consider an IPO candidate. Other than that, to be honest with you, in the Western markets, of what we would truly define as construtech, you would have to take a hard look.
Yeah, I think specifically since it's me, I guess I'll narrow it down again to India. We have, outside of our portfolio, we have Off Business, Zetwork, Lipspace, and Moglix, all trying to go public over the next, I think 12 to 18 months, give or take. All at pretty significant scale. I think all, or at least 3 out of these 4 are very profitable, all unicorns already and operating in the construction tech space.
Is this a result of the latest US presidential election result, i.e. Donald Trump?
I think it's certainty, maybe not necessarily the.
I think it is a positive. I would say it's a positive catalyst that helps it. I think in the case of these companies, and I can also say also true for Inframarket and InfraPrime from our portfolio. I mean, the process has been underway before the election result. So it's not as if, because they came to know the election result, now they've decided, hey, let's suddenly cash in. I think the process was already underway. And to be fair to the companies, I think the fundamentals justify it. In terms of
India is on its own economic S-curve. So in the Indian capital markets have rallied for Sure, what would you say, 2 years maybe?
Yeah.
And that is in spite of a little bit more plateauing in the US and like really no economic growth in Europe in the last 2 years. It has not entirely decoupled. In fact, the in-house analysis that we did in preparing ourselves for the IPOs in our portfolio shows that there is a correlation between US capital markets and Indian capital markets, but it is far below one. It was in and around 0.5, which is a strong correlation, but it is not showing an entire coupling of the two capital markets. And that also allows India, with that correlation in mind, to actually outgrow the US capital markets at certain phases of the economic cycle, which is what we have been seeing. Now, to be fair, Shub, the 4 weeks before the US election in India, you did see decreasing prices in most parts of the capital markets. And that's exactly what we think. Martin, you're right, due to the uncertainty that time period had introduced. And immediately after the certainty was created, the capital was injected again in the Indian capital markets, prices rose again, etc. So the uncertainty being removed is still something good. But India, for the most part, is its own economy, it's its own economic cycle, and it is not as dependent on Western tendencies, etc. It has so much domestic demand power. It has so high demographic dividends. It has such an immense capital domestically to reinvest in its own initiatives that it is much closer to what China perhaps was in the early 2000s than, let's say, what India was in the early 2000s, in my opinion, at least. And that's exactly the point of this episode, guys, is when we think of IPOs, we always think NASDAQ. And rightly so. It is still the most important stock exchange and market in the world. But guys, for construction tech IPOs, the next year, look to India.
Very good. Shall we move to the next topic?
Yeah. Anything else to follow on this one, or are we okay to move on?
I mean, just as a closing remark, because I kept saying, Martin, that I owe you a response to your question on Swiggy and BlackBuck, but I never got around to it. I don't know if our viewers and listeners realize this, but believe it or not, as of now, the Swiggy IPO is the largest tech IPO in the world this year, which is a statement I was not sure if I would ever make about an Indian company, like ever. It felt like just until a few years ago, the thought of Indian tech companies doing large-scale IPOs was crazy one. And to get to the point where an Indian tech IPO becomes the largest tech IPO across the world in a year, it's actually mind-boggling in my view.
Cool. Okay, let me share my screen.
Sorry, as you do that, Owen, there was another interesting tidbit that I learned today about Zepto, Shub, the Indian quick commerce market leader. And by the way, just for everyone who thinks quick commerce is shit, like me, Zepto is actually not. Zepto has very solid unit economics that they demonstrate. And so what I didn't know, and I learned today, that 2/3 of the current ownership of Zepto is foreign. Is that historically, in the context of high quality Indian companies, is that like a 2/3 being foreign? Is that like high? Is that low?
It's actually normal, Patrick, because most institutional investors, VC funds, for the most part, not always, but for the most part, will be domiciled outside of India.
Oh,
Got it.
But I know the context in which you're bringing this up. That's because they're raising a new round with Indian family offices just to boost the level of Indian ownership.
Exactly. Which is very interesting to perceive, right? So now that the Indian economy has its own liquidity, its own capital strength, it also has the self-confidence to say, no, in these high quality companies, we want to add much more domestic capital, with 2/3 being foreign. So that to me is a demonstration of self-confidence of the Indian economy.
There might be a nuance to this, which is that there might be this capital kept in Seychelles or Mauritius, and I've heard there's a lot of funds that are Indian funds, and they keep the companies in there for the very favorable taxation purposes. So the question is it foreign from those regions, or is it foreign from, like, let's say, US based funds?
I mean, look, you brought up taxes and India. I wish we had another hour spare to talk about everything I've been going through for the last 2 months with regard to our holdings in India, I would say that is one part that India does not do well, right, for foreign investors. And what you're talking about, Martin, is specifically an advantage that existed due to a treaty between Mauritius and India until 2018 that foreign investors used to take advantage of. Unfortunately, that treaty is not valid anymore.
Okay.
So even if you're based in Mauritius, so there's nowhere in the world you cannot get away without paying taxes in India on a withholding at the withholding level.
So they are truly foreign and feels
Yes.
Okay.
Okay. Martin, do you want to talk about this picture that I have on the screen?
Yeah, sure. So yesterday I visited London Build in London Olympia, and I was super surprised when I saw this picture, Office of Zero Emission Vehicles, and me being Eastern European, born in 1991. First thing I had in my head once I saw it was, it's like a communistic ministry of something, because at that time of communism and the eastern part of Europe, there was ministry of everything, trying to regulate every single part of business activity or any human activity, really. So it seems like overregulation and nonsense. That's what I would say on that.
Is this an office that determines what standards should apply on bicycles?
Yeah, that probably these bicycles would fall into it as well.
That's a different office, Shiv, actually.
Oh, I see.
That's the office of bicycles.
Yeah, I think it just represents how far people go with the over-regulating things, and my guess is not much good things will come out of that, really. But that's my take.
Mm-hmm.
Any idea what their mandate is or what their mission is?
Shall we do a quick search? You have Perplexity Pro mine, right?
I do have, yeah.
I can do it quickly if you're
Probably,
one
yes.
step ahead. So, wow, they have 7 points. Shall I read them?
Mm-hmm.
To
Go for
promote
it.
and support the adoption of electric and low-emission vehicles, to provide grants and incentives for individuals and businesses to switch to electric vehicles, to support the rolling out of charging infrastructure across the UK, making it easier for drivers to charge their electric vehicles. In mine, actually, maybe there is use. To fund and support research on emerging technologies related to zero-emission vehicles, to advise ministers on matters concerning the transition to low-emission vehicles, to work towards reducing carbon emissions and improving air quality, and finally, to support the government's transport decarbonization plan, which aims to build a net zero transport system by 2050.
Yeah, but you could create such a list for every single cause you can think of, and that would sound good. But at the end of the day, that would hinder the human activity. That's just my assumption.
Patrick, is there an equivalent in Germany?
Oh, I'm sure there is. We probably have an office of potato seeding. I'm certain. I look at this from the perspective of economics. So whenever you give any kind of stakeholder group the ability to self-perpetuate, it will self-perpetuate and become a behemoth of its own. And the definition of self-perpetuation in an economic sense, how I define it, is when it can create its own demand. The moment you give a stakeholder group the ability to create its own demand, it will never go away and it will spiral out of control. Lawyers are exactly like that, because lawyers have the ability to create more complexity for the economy, for the clients, etc. And that's why they have an incentive to continuously create more complexity, which they are needed then to manage. Tax consultants, notaries, auditors, compliance, and the government, they always have the incentive to create more demand for their complexity management services. And that's why, unfortunately, they spiral out of control, in my opinion. And sometimes you might need someone with a chainsaw standing on a stage.
You read
saying,
my
"Hey,
mind.
I'm cutting through the jungle, and we need to start over in order to kill the self-perpetuation."
Patrick, as you were saying that, I was just doing something which I will paste on the screen.
Yeah.
Here it is.
You can like the guy or not. You can, nobody has the perfect answer to everything, right? And so certainly Javier Milei in Argentina doesn't have that either. But one thing to me is very clear, just from the perspective of someone with an economics background. If you want to kill self-perpetuating demand of these type of stakeholder groups, at some point you do need a chainsaw. Otherwise, the self-perpetuation will go on.
I agree. Okay.
Let's go to the investor's take. Something a bit more lighthearted, should I say. Okay, so who here agrees with the statement on the stage here? It says, you will never have a greater opportunity to change the world than by being a VC.
Wow. It's actually a funny one, yeah?
That is quite
All right,
crazy.
guys, explain how do you guys change the world in
Change my world.
That's what I'm
actually, what really matters?
Yeah, I'm really tired of male people thinking they should voice their opinion on everything. You can have an opinion on everything like I do, but man, just shut the fuck up when your opinion is not relevant. It's unbelievable. It's this is such I can't say how just dumb this take is.
Hey, I just realized something, Patrick. You know what maybe the person's referring to by changing the world is by taking all of the LP money and making it illiquid and worthless.
Yeah.
That's like a lot of change going on.
Yes, it's changing hands. You're right.
Yes.
Yeah.
Sounds like a slide from like a nice TED talk about some nice idea.
The audacity of driving propaganda in the VC industry by not even attaching the true meaning to words anymore. Like in this case, never and greater. These are very, very absolute statements in what these words are supposed to mean.
That's true.
And the guy has the audacity to stand here. Again, it's a male person with a lot of privilege. Never greater. I mean, it's just, dude, whatever happened to nuance? And then just saying that is by being a VC, I think this is a slap in the face of every founder. Sorry, a VC is a capital allocator whose sole job is efficient distribution of capital in the most high promising projects and ideally minimizing the amount of losses along the way.
Mm-hmm.
That's what it is. Tell me how that is changing the world more, which is what this guy is claiming, than the people who are actually building the businesses. That is such a ridiculous take. That this guy deserves to get taken off stage and put in a prison for 30 days to learn how to shut the fuck up. Sorry, it's the amount of propaganda in the VC industry is the one thing that riles me up.
Actually, this reminds me of, I think, a quote, or maybe, I don't remember if it was an opinion or an actual quote that I'd come across a few years ago, which it's really funny if you hear it, but it's maybe much closer to the reality of the situation, where, the person said, VCs love to come to the rescue of companies who don't need them.
Yeah.
So we want to pretend like, hey, we are the saviors, but actually, it's not really changing anything at all. The firm would have done fine regardless.
Yeah, it's interesting for me observing, learning from like tons of the podcasts we've done, conversations with people. It feels like it's a very wobbly industry as well. And like, I think one of you mentioned earlier that there's lots of people coming into the industry not having like financial background perhaps, but being brokers and not being too technical about how they allocate this capital, but being more signalist of where this capital is going, and then copying, pasting.
I think we might have discussed that during the Fundamental Super Series.
Mm-hmm. Yes. Yeah.
When I Martin, let me build on that. So, and connect it back to what we have on the screen here with a statement. When I started my first job, it was a highly quantitative job. And my boss back then, and that was too extreme, but basically say, hey, if your slide doesn't have a number, it's not a slide worth having in the slide deck. And so this guy literally has a chart here with absolutely no proof, no numbers, nothing. That is the propaganda that I absolutely hate in this industry. Hey, this is the best company ever. I remember, Shub, you will remember this, a British podcaster turned VC that said about a Pakistani company sometime in and around 2021, without backing up any of the claim, just said, these are the most insane unit economics that I have ever seen, and that's why I led their Series B. The company is dead today, I think, Shub. Is that right?
Not only is it dead today, it was dead less than a year after that statement was written.
That's propaganda. If you make big claims, you're supposed to back them up. And so to make a huge claim like this one, never greater, you should have a number to back that up. And instead, the amount of propaganda in VC is, let's not back it up. Let's just make random claims.
Yeah. So you brought up something which I know and quite often, quote unquote, fight for, as I call this behavior Western marketing, just saying stuff without any substance.
Yeah.
And without any like propping with numbers or anything that helps this claim to stand.
I help people dream, baby. Come on.
No, get into the reality of things.
Well, maybe we can move on to another investor's take, which may actually help you change the world. Let's skip that one quickly. We'll go to this one. Podcasting. So on the screen here, there's an article by TechCrunch, which says in 2023, VCs returned the lowest level of capital to their investors since 2011. And someone has taken that and retweeted it with their own quote, a guy called Matt Turk. And he says, okay, but we dramatically improved our podcast game.
That's probably true. 2023 is, I guess, an unlucky year after the craziness of 2021. And people who exited in 2023, I guess the multiples were super low, and that's why this data is showing such a bad returns. What do you guys think? Is it just 2023 was a bad one because of very high valuations year or 2 years prior, or that's perhaps a more trend right now that will be these returns will be lower? How do you interpret that?
I haven't read this piece from TechCrunch, although intuitively I think seems spot on. If what the data says is the returns were the lowest in absolute amounts, as in millions of dollars or pounds or euros, that would be quite shocking. If it mentions more, if it's more a ratio of the amount of money returned as a proportion of the fund sizes, that I think, in my opinion, is 100% bang on. If it is also in absolute terms, that would be an unbelievably bad situation, because then in that case, we're saying, hey, the absolute amount of money coming back is very low, while the fund sizes have ballooned or had ballooned as of 2021. And look, Martin, in response to what you said, sure, the multiples did lower, but I think most of the exits, or many of the exits that happened in 2023 weren't really exits in the conventional sense. There were more forced sales, fire sales, pay-to-play situations being exercised, that sort of thing. So I think what the most of the cleanup or the cleanup that was owed to the market as a result of all the money that went in 2020 and 2021, most of it, I think we probably saw the worst of it in 2023. I think we have still not fully seen all of it exit the system in terms of either fire sales or shutdowns and stuff. There's probably still more in the making, but I feel like 2023 was perhaps the bottom.
It is actually the absolute, Shub. Wow. It is the delta, which is absolutely shocking. So the study is based on a PitchBook study that Wall Street Journal originally published. And what it is that the absolute amount of distributions is indeed the lowest since 2011. There's not the exact number here, just by eyeballing, it should be around 26 billion that was returned in 2023. And if you then take the delta, contributions minus distributions, that delta, so that the let's call it net cash flow of the VC industry, is the lowest in the last 25 years.
Yeah, because if in absolute terms is the lowest it's been in 13 years, that's unbelievable, because the fund sizes on average must have, in the meantime, maybe tripled or quadrupled, maybe even more in some cases.
Yeah, and 2023 was AI boom. So we didn't, as an industry, we didn't hold back investments either. So that explains the delta as well. Why you actually called so many contributions in order to invest, yet you distributed so much. That's why the delta is also the highest that it was in 25 years.
So it's actually not what I was thinking, that because of a very high valuation investments made in 2020-21, you had such a low exits at 2023, because this exit wouldn't happen so quickly, right? So this is actually the result of investments made from perhaps 2015 or something.
No, actually, most of the capital contributions in VC come in at growth stage, where typically you would target a much shorter time to exit. You're right about the 2021 and 2020 to a degree effect. But that's because of the growth tickets that were written. They have by far the disproportionate share of the contributions into VC.
What's your best guess moving forward?
In terms of distributions?
Returned capital to investors in the VC space.
I can go, Shub, and then you might have a different take here. If I put a lot of money into funds that were raised in 19, 20, 21, and that had no time diversification in them, meaning they basically invested the capital sometimes within less than a year, sometimes within just 1.5 years, most likely I will be happy to get 1x back. But in my opinion, many of them will not even return 1x back. Those vintages where we're going to see sub 1x DPI funds a lot, and uncomfortably so. And I think LPs actually have only realized what kind of dog shit they have in their portfolio from these vintage years in the last 1.5, 2 years, maybe, because markdowns take time, and some GPs unfortunately don't mark down, as proactively as we, for example, do it. But I'll let Shub answer as well. Before you go, Shub, just one fun fact. I just looked it up to validate it's true. Fundamental actually returned capital to its LPs in each of the last 4 years.
Very good. Congrats.
Thank you. Look, I would like, so there's what I would like to believe would happen. But I think there's also another thing which perhaps is equally or even more likely to happen. What I would like to happen is for those investors who are overexposed to what happened in 2020 and 2021 to then use the opportunity of what's probably coming in 2025, which is a rosier market, to use the opportunity to get some exits, get some distributions under the belt. I think what unfortunately we may see a lot of, because that's the nature of the cyclicality of this industry, we'll again buy into some other hype of how things only keep going higher, how there's always going to be more liquidity, how everything has got to become a unicorn super quick, and therefore we have to pile into large overvalued rounds all over again. And for that, again, you'll have to, call in a lot of money and deploy the fund quickly to make those kinds of rounds happen. Because keep in mind, the assumption is the venture market will be strong in 2025 because there will be a lot of funding activity going on. But if everyone's exiting, who's funding? You know what I mean? So both statements, unless the participants are different and they've completely disjoint personalities operating independently, but when does that ever happen in venture, right? So if there's a lot of funding activity, logic would suggest a lot of that optimism would spill over into euphoria and animal spirits and whatnot. Mm-hmm. So would you really want to be exiting your entire portfolio if you truly believe everything's going to the moon?
No.
I'm not sure. I think we may see at least some of the cycle just perpetuating and carrying through once again.
Interesting. Mm-hmm.
Nice.
I'm also very curious. Patrick, you mentioned that LPs started realizing in last year and a half, about what I think you quote dog shit they are invested in. Or did you guys find that when talking to your LPs, they have like different due diligence processes, perhaps, or they have changed in any way, or not really?
Our LPs, should correct me if I'm wrong. I think we have LPs whose VC investments are mostly in emerging managers and sub 250 million funds across their portfolios. And that in and of itself already historically, statistically, and proven, will expose you to much higher return potentials as a fund investor in VC than if you were to invest in mega funds, 500 million, a billion, 5 billion plus. So there is diligence process potentially that plays a role here, but it's also an allocation strategy game that will expose you to different kinds of risks return profiles in VC. And to give you the counter example, we don't have such an LP, but if you're an LP that actually let me give you the real example to make it visible for people who maybe don't interact with LPs on a daily basis. You will encounter a lot that large sums of money, LP money, are managed by employed managers, not owners, that will come to a fund GP saying, hey, I need to put at least 30 million, ideally 50 million. What's your fund size? Now, when you start with that profile, with that mentality, you're already cutting out writing checks for sub 100 million, 150 or 200 million funds, because usually most of these LPs have a secondary constraint where they say, but we don't want more than X% ownership. Because for some weird reason, they think that their risk profile is different if they own less of a fund. Explain to me how that makes sense. But anyway, that is actually part of the allocation mentality that a lot of these employed investors at institutional LPs will have.
Might be signaling as well. They need some signals from others.
Maybe it's signals, maybe it is cover your ass strategy internally. It could be a combination of the two. Yeah. But when you have those two constraints, you're already limiting your allocation strategy to mega funds. Now, when mega funds know this, they can play you like a fiddle. Because the third thing I'm going to do is to show you, hey, I have the biggest brand. I have the best deal flow. Have you been to our LP conference? You get to meet a lot of people. You create a lot of chatter about yourself. And then you're showing them all these promises of huge returns, and you're doing a lot of techno optimism. So you're going to say, hey, the only reason why we don't have more unicorns is we need to create more founders. And by the way, we're going to colonize Mars soon, but we don't have enough founders yet to do that. So now you're creating this system where someone that wants to put 50 million into a highly credible GP with a lot of techno optimism, and you don't have to write 10% of the fund because you think it's certain that you get 1.8x of return. Do you know how poor 1.8x actually is over 10 years? That is like absolutely dog shit performance. Sure, but what is that on a yearly? 5%?
Yeah, I think 5 to 6%.
Yeah. So, sorry, I always ask Shu because he's better at head math. But as you can see, I'm also good at estimating. Yeah. So that's about 5%. I mean, if you invested 5% into the NASDAQ, you will get better returns.
Yes.
For sure. And no fees, by the way. So that's why I think, Martin, most of the LP money actually is very, very poorly allocated. And I can only say, final point here, before I let you guys go, I have made it a principle. When I invest my personal money, I only invest it in companies, be it funds or direct investments, where the owners of that company make the decisions and have still a large portion of the company. Which means I, for example, refuse to invest in publicly listed companies that are not owner-led. I do not do that because I think the amount of the quality of decision-making in companies is highly correlated with the amount of buy-in and skin in the game of the leaders of the company.
Okay. Sure. Any thoughts on this?
On allocation of capital from LPs?
Perhaps, yes.
I mean, look, it has been, you need to look at only the numbers that, VC by itself as a trade or as a profession is highly skewed. I mean, it's I'm trying to recall the exact quote it's a game where you're encouraged to go for the home run. So it's highly skewed in favor of those funds which have a large hit in their portfolio. And the interesting thing is it extends beyond just a single venture fund. Even in venture capital as an asset class, outside of the top decile, maybe the top 20% of funds, the rest of VC as an asset class doesn't even return back the principal. I think that's been found consistently over and over again over the last 30 years of LPs investing in venture capital. So what that obviously means in very, hard numerical terms is somewhere between 80 to 90% of the amount of money invested in VCs, or at least the amount of firms invested in, the amount of investments made in firms, 80 to 90% of that, it's just poorly allocated. And sometimes the poor allocation is a result of too much money going in.
Yes.
Perhaps if only fewer dollars were given, it would have been better allocated. So is there a capital allocation problem towards VC? Yeah, the data shows it in extremely obvious detail.
Okay. All right.
Just a bombshell way to end.
Yeah. Maybe should we ask you another
Wow.
the last?
Yeah, I mean, so the takeaway is VC sucks. We all suck. And whoever's listening to this also sucks.
No.
I'm so glad
the takeaway will be the answer to my last question. So did you guys dramatically improve your podcast game?
I mean, I guess say that. Are we like leaning in hard into doing exactly what Matt seems to be saying?
Yeah, you guys are over number 50 now, right? When was that, last week?
That's right.
I mean, if you measure improvement in terms of quantity, maybe.
Very good.
I think we've made a few improvements. I think the first few episodes of Practical Nerds were a bit rough. I mean, I still had fun, but they were rough. I think now, I think we have ever so marginally improved our game there.
Mm-hmm.
Yeah.
So I still have an anecdote on the capital allocation, guys. I have to share it because
Go for it.
it's stark. So I recently talked to a debt fund.
Fund.
A debt fund that allocates capital into tech companies, for example, but it's a debt fund.
Mhm.
Okay. Managed by an external manager. That external manager convinced a capital allocator to sit in the mezzanine of the capital structure of the debt fund. So this is a technical term. Look it up. I won't explain it in elaborate detail, but it means you're not equity and you're not sitting at the top of the liquidation stack because you're not debt either. So I asked the manager, hey, why in the hell would someone get to the idea of giving you mezzanine capital in your debt fund rather than giving you that as a debt? The answer from the manager was because they're stupid. That explains that, like when you think Wall Street, don't think competence. Just think incentives. They probably have money lying around and someone said, hey, this money is allocated to mezzanine. So we should have a mezzanine strategy. And then this employed manager, not an owner, probably thought, hey, this guy is pretty cool, this fund manager. Let's give him mezzanine. Although in a debt fund, that is like something that shouldn't be your first priority, to be putting it bluntly.
Finance sounds like a land of opportunities.
Definitely putting the strings up there somewhere.
All right, guys.
Okay. All right. Well, Shub, thank you so much for joining us. And Patrick, we will see you next week.
Thank you, guys.
Thank you.
Thanks, Shub.
Thank you.